All right. So now it looks like we've got a good amount of people in, so we can start. So two quick notes before we start. First of all, thank you for joining us to discuss our conditional parameter optimization webinar today. Two notes, we will be recording this and uploading a recording next week. So if you miss anything or want to rewatch it or miss any concepts, keep an eye out for that. Additionally, if you have any questions as we go through, please keep that in the Q&A as opposed to the chat box, just so all the questions are kept in one place for chronological order. Without further ado, I'll pass it to Ernie to do the presentation now.
Thank you, Eric. Welcome everybody to the webinar today. This work on conditional parameter optimization is done with my colleagues, Radu Silvanu and Sergey Belov. Their names are our co-authors in the paper that accompany the webinar. So the idea of parameter optimization is, of course, very familiar to many traders, but actually, let me go to the next page. What we have added to this very familiar concept of parameter optimization is to adapt it to different market regimes. And that, I believe, is something new that haven't been really thought of much before. So what are regimes? Now, some of these regimes in the markets are very familiar to investors and traders. Of course, they are the bullish and bearish regimes. There are the flat and chop versus choppy regimes. There are risk-on versus risk-off regime. Risk-on meaning people are very eager to take risk. They buy equities, buy emerging market currencies, buy high yield bonds, versus risk-off regimes where people are very conservative and very risk averse. They sell equity and buy government investment grade bonds. They buy US dollar and short emerging market currencies and so forth. And then there are inflationary versus deflationary regime and so on and so forth. These regimes, being so familiar and so visible, are typically affect every portfolio and every strategy. There are hardly any strategy or any portfolio that are not affected by whether the market is volatile or calm, right? And these regimes, being so familiar and visible, are also easy to identify after the fact, right? So you can look back in the year 2020, let's say March to April, and say, oh, those are that's certainly a risk-off regime. But after June, you might say, oh, now suddenly we are on to a risk-on regime because everybody's buying high-tech stocks. It's easy to identify after the fact, but try predicting them is not that easy, right? If you could have predicted that in March 2020 we'll have some days that are down 15%, you would be very rich by now, right? So it's easy to identify a posteriori, but not easy to predict. And in fact, predicting the onset of a new regime can be as hard as predicting market directions. Now, as opposed to these kind of visible, observable regimes, there are also hidden regimes that are even more subtle. For example, people say that there are a lot of these retail traders, Robinhood traders, that are buying call options on these small, stocks such as GameStop, for example, such as AMC. Is that a regime? Does that cause a market regime change that affect many strategy? Apparently it did, but it's hard to put your finger in it. What does a regime call Robinhood traders buying call options? What's the name for that regime? Or a large family office articles liquidate and causing a contagion among many prime brokers, all liquidating together. Is that a regime? Does that cause fundamental market structure change, at least for that period? And more generally, some of these hidden regimes are specific to affecting only some strategy. Why is it that my profitable strategy that had worked for several years suddenly stopped working in the last few months? Is that because of regime change? So these regimes, these hidden regimes, are not easy to identify. They are not observable. They may only affect certain strategies. They may benefit some strategies and negatively affect other strategies, but they may have no impact on yet other strategies. These hidden regimes, therefore, are hard to identify, but actually they could be easier to predict, using a large number of factors. So our job as machine learning, as the financial machine learners, is to predict these hidden regimes. And why is it that it's easier to predict hidden regimes than these observable regimes? And one of the reasons is because not everybody are trading the same strategies. And as George Soros say, reflexivity is what kills a lot of predictions, right? If you can predict a regime, typically the regime might go away. Let's say everybody is predicting a bullish regime and they buy up the stock ahead of time. Well, there's no marginal buyer left, and that might cause a bearish regime to come about sooner than expected. So the fact that if you can predict an observable regime is like able to predict the market direction. The fact that you can predict it means that the market direction will change, and it also means that the observable regime will change. Whereas if you are talking about predicting hidden regimes that may only affect your strategy and other similar strategies, not everybody are trading those strategies, not everybody is making the same predictions, and so those predictions might still endure and stand, and it will not be arbitraged away. So now, everybody want to predict regimes, whether they're observable or not. The traditional, and there are many methods that have been proposed traditionally to make this kind of regime predictions. One of the more popular method is state space models. A particular type of state space model is hidden Markov model, for example. But these models have been very weak. They are not very predictive because the only input so far are prices. Right? The traditional hidden Markov model try to use prices to identify hidden regimes, but because prices are very just one dimension, these models are very weak. Now there are further improvement to that, and actually applying more features to hidden Markov model, and that is the paper that I identify here at the bottom, called feature selection in jump models. That's a paper that one of the co-authors of this paper sent it to me after we published our work on conditional parameter optimization. Professor Pettercombe sent his paper to me, and it's very interesting because it, in parallel with our work, they also incorporate many features in the format of a hidden Markov model in predicting regimes, but specific to jump models. So you might want to check out these kind of parallel methods. For us, our objective is actually very direct and very simple. How do we identify regimes implicitly in order to adapt our trading models parameters? We are not so much interested in identifying the regime per se, because as I said, these regimes are hidden, they are very subtle. Just because you identify them doesn't really lead to any actionable item. So the actionable item that we actually want to engage, want to deploy, is parameters. What parameters should be changed for our strategy if we can identify this regime? Now, going back to why traditional hidden Markov model or other in general state space models are not so predictive, and how we can improve on it, and why machine learning can improve on it. Well, one reason, as I already mentioned, that machine learning model can make a stronger prediction than traditional models, state space model, is because it can incorporate a much larger set of predictors or features, as we call it in machine learning. And the other one, and the other reason is that very often machine learning model can handle nonlinear interactions. Of course, we are not thinking about logistic or linear regression, which can still be considered machine learning. We're talking about more complicated machine learning models such as random forest or even deep learning networks, all of which can handle nonlinear interactions between among predictors. These nonlinear interactions are important to capture because a lot of times the predictors have a conditional dependence. And a simple example would be, let's say you want to predict whether tomorrow is going to be a volatile or not volatile regime. Well, it might be that if today's fixed level is under 20, a set of features would be useful for predicting tomorrow's fixed level. However, if fixed is above 20, a different set of features might be important. So there are these conditional dependence, which are difficult to tease out manually and difficult for a traditional state-based model to model, but they are ideal for a machine learning algorithm such as random forest to take care of. So these two factors, these two reasons, the ability to incorporate much larger pool of predictors without overfitting because of advanced feature selection algorithms that I talked about in my earlier webinars, and also the fact that you can take into account nonlinear interactions as well as conditional codependence of predictors are what led us to using machine learning for regime identification and parameter optimization, which is the work that I'm going to talk about today. And by the way, if you have any questions at all, please feel free to post it on the Q&A board. I'm happy to answer them. I like to take little breaks during the talk, before we get to the end. So please feel free to post your questions to the Q&A panel. Okay, so now some of you have heard of other machine learning techniques that are applicable to finance. In particular, you may have heard of meta labeling. So it is worthwhile to understand what's the difference between meta labeling, which is quite well known since the publication of the Advances in Financial Machine Learning by Dr. Marcos Lopez de Prado, and our notion of conditional parameter optimization. So meta labeling is a technique to learn from a portfolio or a strategy's past track record, augmented with big data to predict the probability of profit of that strategy or portfolio. Whereas in conditional parameter optimization, we are also learning from the portfolio strategy's history, but this history typically is based on the backtest, not necessarily have a live history. It can be, both based on backtest, and also augmenting with big data. So far it's the same, right? So far the two parts are the same. The conditions are the same, but the objective is to optimize trading parameters. It's not to decide on capital allocation or leverage, but to optimize the trading parameters of a strategy. Now, clearly, when we talk about trading parameters, we are thinking about a quantitative strategy, an algorithmic strategy. Meta labeling can easily be applied to discretionary trading, whereas conditional parameter optimization is typically, we are dealing with algorithmic strategy, where you have clearly defined parameters for entering trades or exiting trades, and also clearly defined backtests where you can find out how the track record will look like under different set of parameters, which is very difficult to do, as you can imagine, for a discretionary strategy, right? How do you reproduce the history in a discretionary strategy using different parameters? That's very tough. So only, really only this particular technique really only applicable to algorithmic strategy, where you can identify, where you can create backtest or simulation. So there's one question. Let me answer live to that. Are you trying to identify features for regimes, such as volatility greater than 20 or volatility less than 20? Indeed, we are. But we don't need to do that manually, right? So we are entering a large group, as in many machine learning projects, we are entering a large group of features, some of which may be completely useless. So a lot of them may be redundant, right? But applying feature selection, we will be able to identify those that are useful. And the machine learning algorithm will automatically build a predictive model based on them. Whether volatility is an important variable for predicting tomorrow's volatility, the machine will decide. And as to what threshold is important, again, the algorithm will decide. So we do not need to manually establish these kind of rules. Okay, so again, meta labeling is to use the probability of profit that the machine learning predictive model established for risk management and position sizing. Determining what portfolio allocation you should use, deciding what leverage you should use. That's meta labeling, and it's again well known since the publication of advances in financial machine learning. But conditional parameter optimization is different. It is to improve the base strategy's trading performance, not just using capital allocation to manage its risk, but actually changes to some extent the base strategies, because the parameters can be different for every trade. And meta labeling typically use classification models in machine learning, meaning they are identifying whether the trade, the position or the trade or the portfolio will be profitable or not. So profitable or not are two classes, right? And applying probability to those two classes. Whereas in CPO, in conditional parameter optimization, we need to use a regression model. We actually need to predict the expected return of a strategy in order for optimization. So that's a more technical difference between meta labeling and CPO. Okay. So these are all nice and theoretical. So let's put it in the context of a concrete trading strategy. Let's examine a Bollinger Band based mean reverting strategy on one of my favorite pair of ETF, GJLD versus GDX. That's the gold trust fund versus the GDX, which is the gold miners ETF, right? That's my favorite mean reverting pair. And it's a typical trading strategy would apply a Bollinger Band to this pair, and with a certain specific hedge ratio between them. It does not necessarily have to be 1-to-1, right? Not $1 GLD to $1 GDX. It could be $1 GLD versus $0.7 of GDX is the optimal hedge ratio. Anyway, with this kind of Bollinger Band based mean reverting strategy, there are typically three parameters to define the trading strategy: the hedge ratio, how many dollars of GDX should we trade versus $1 of GLD, and an entry threshold, namely, how many multiples of the moving standard deviation do we use for setting the Bollinger Band, and finally the look back for the moving average and the moving standard deviation to define the Bollinger Band. So this is a toy strategy. Okay, don't take it too seriously. I'm not suggesting that you should go out and retrade it, but it serves as a good illustration of the technique. And this is a strategy that has three simple parameters. And your strategy might have more or fewer, of course. So how are we going to pick these parameters? That's the question we want to answer, right? So, well, first of all, in order to optimize parameter, we have to find out what's the objective that you want to optimize to. Typically, it could be a Sharpe ratio, or simply annualized return, or yet other, some other might favor value at risk, or the variance of the return, and so forth. So you define the objective. I'm not here. It doesn't matter what objective it is, as long as you define it. It could be any metrics. Now, the traditional method of optimizing the portfolio, the trading strategy, in order to meet this kind of, to optimize this objective, is either to use a fixed training set. Okay, so let's say you have 10 years of historical data, you use the first 5 years and run your backtests with different parameters so that they give you the best Sharpe ratio, let's say. A more perhaps intelligent way is to apply walk-forward optimization, FWFO, where you have either a rolling look-back period that where the strategy performed best, where the parameters perform best in that rolling look-back period, or an ever expanding training set. So you start with 5 years training set, but after 1 year, you will use 6 years of training set to optimize, and then 7 years of training set to optimize, but always using the best parameters optimized on the look back period, never in sample, right? So that's the traditional parameter optimization problem. Of course, in this problem, in this traditional method, regimes cannot be accounted for. Optimal performance in the most recent period does not at all guarantee optimal performance in the next period, because the next period might have a different regime than the previous period. A strategy with optimal parameters for a risk-off period can hardly be optimal for a risk-on period, for example. Similarly for bullish or bearish, and even more so for the hidden regimes that might only affect your strategy, not the general market, right? So neither method really help us in adapting parameters for live trading strategy. And furthermore, as I said, none of these methods make use of other predictors. They are only looking at your strategy versus the market, but they don't look at a whole group of other potential big data predictors that can help define the regime, that can help improve the strategy for you. That's the state of the art. That's the traditional portfolio optimization. So what can we do? Well, what we do is that we can use a set of features which can capture the general market condition. Now, generally speaking, it will be a very large features. I advise people to look broad, incorporate as many features as possible, hundreds if possible. Okay, the more the merrier, because you don't care if they're useful or not. We have a standard method in machine learning to reduce them to a smaller set that are really useful. The notion of feature selection. We have written and talked about a lot of good feature selection technique that you can reference. If you go to our website, PredictNow.ai, you will find papers and talks on feature selection, but let's assume that's done. So use as big a group of features as possible that represent all aspects of the market that might affect your strategy return. Okay. After that, train a machine learning model based on your historical strategies return and these big data, and trying to predict their return. Okay, so you are trying to predict your strategy return. You're not trying to predict the market's return. So you are trying to mimic your strategy as much as possible using this sort of big data. Okay, and part of the features, and that is the most interesting part. The part of the features are the trading parameter of the strategy. In other words, let's say you have a 10-day moving average and a 1 standard deviation entry threshold and a hedge ratio of 0.5. What are the expected returns given that day's condition? And what about a look back of 20 days? What's the expected return? Now, you might say, well, how could the machine learning model know what the strategy will produce with a 10-day look back period versus with a 5-day look back period? How could it possibly model that? Well, you can create the backtest data for it to learn, right? You can, because this is a algorithmic strategy, you can run this strategy with a different look back, 5, 10, 15 days in history and see what the actual return is. So the machine learning model can learn from that, from the specific parameter value and the market condition to predict what the strategy will look like, will return. Okay, so these are what we call control features. These are features that you can vary at will because it's a backtest, and therefore you're not at the mercy of the market. You can precisely vary them, and in order for the model to learn from the past, how it performed under different regime, right? So a table might clarify that. So for example, in this table, let me see if I can generate a little pointer here. There's a pointer, yeah. So in this table, you have the first 3 columns are what we call the control parameters, right? The GDX weight of $2 versus $1 of GLD, entry threshold of 0.2, look back of 30. And these other group, this other column might be the actual market features. That's something that you cannot control, right? And then on the second row, another sample, you will give it a different set of parameters. Maybe this time the look back is 60 instead of 30 days. But of course, the market features are the same because you are talking about a particular day, let's say. So you cannot change those market features. And so on and so forth. You can vary these three combination of these three control parameters, but you cannot vary the rest of the features because they are market features. And this table altogether form the input training data for 1 day. Of course, you will repeat this for many days, right? So this is just a table for 1 day only, or 1 bar in general. You are going to vary that, replicate that. So the data set can be quite large if you have a lot of parameters, because there's a certain combinatorial explosion going on if you have too many parameters. So hopefully your strategy doesn't have too many parameters. Otherwise, it will be hard to optimize, just like any traditional parameter optimization method, right? So, okay, so there are some questions here, which unfortunately was typed on the chat screen. So if you can type your question on the Q&A, it would be easier for me to find them, because then I don't have to look at both panels. So a question from Sayuj is, are these control features vary based on parameters, or are some random variations? Well, as you can see in our variation of these parameters, they are systematically varied. So, you want to look at how the strategy performed with 30-day look back, 60-day look back, or 90-day look back. If you are going to use this strategy live and determine what kind of optimal parameters you should use, you will have to recreate them in your backtest data. So if your backtest data does not contain a row with a look back of, let's say, 35, you could not possibly get a 35 at the optimal parameter, right? So you have to recreate these optimal parameter values in your backtest. So that will determine what value you can use in live trading. So the more fine-grained you are, let's say you want to predict the look back in increment of 10 days. Well, then you have a lot more data in your training data, because you will need to learn from a finer grid of parameters. They are by no means random, because this is an exhaustive search. Okay, so another question from Cameron is, are the timescale fixed and or the variable over which you are optimizing? Are they fixed 1 week horizon or not? Well, in this particular strategy example, we are looking at daily data. We are looking at predicting the strategy profitability on a daily period. The parameter will be fixed for the entire day. But of course, that is just specific to this example. In real life, you can set any, you can adapt the parameter however often you want, hourly perhaps, right? It's subject to your computational resource. How often you want to update these parameters, and how often do you want to predict them. The more frequent, of course, the more data that you need for training and also for live prediction. Okay, so let's see what's done. Can the parameters be hyperparameters of different machine learning models? Okay, that is a good question. And the answer is no. The parameters that we are talking about have to be parameters of the underlying trading strategy, because the hyperparameters define the learning algorithm. We are applying the learning algorithms to this data set. So you cannot learn their own hyperparameters, right? Because whenever you are trying to use a machine learning model to learn from data, you are fixing their hyperparameters. So you cannot learn its own hyperparameters that way. Okay. Here, Jigger has another question. How about using unsupervised machine learning? Yes. So actually, state space model and hidden Markov model are in fact considered unsupervised training model, because you do not explicitly identify the regime in a hidden Markov model. You don't know what the regime. You oftentimes don't even know how many regimes there are, not to mention identify which one of them. So they are unsupervised training, and they are very weak as a result, right? So that's actually one of the drawbacks of traditional model. Okay, so one other question from Jack is that in the current table that we are looking at, is the result of the backtest the model we predict the return of a given strategy on a given day? That is correct. So the label for each day. So what I'm showing you is a feature table, right? So of course, for each row of this data, there is a corresponding label, meaning the variable that you want to predict. So that represents the return of the strategy for that day, not the average return of strategy over several years, but for that specific day. Remember, we are assuming that we are fixing the trading parameters for a day. Now, if you are fixing the parameters for 1 hour, then of course that will be the total return of the strategy for that hour, because that's what we want to optimize, right? Let's say we want to optimize the return of the strategy in that particular hour using these parameters. So that's going to match the time horizon of your training. Yeah. So Bob has a question. Are you training your features independent from other features or together as best combination of parameters? They are together. So the control parameters and the market parameter, the control features and the market features are put together, merged in the same feature input table. So it is all together. Yeah. And all these parameters are also mixed in. So, you know, we have 3 parameters in this toy strategy. And they will be used, they will be part of the same feature table. We do not optimize one parameter at a time. Okay, so let me see if I have missed any questions on the chat. No, okay, that's good. Okay, so let me move on. Given this table structure, thank you for your question, by the way. It's very illuminating because it can be confusing. So now this table is constructed, like I said, for each day in our example. But even for each day, there are many rows. These many rows correspond to different combination of the trading parameters and their expected return. So you can see that the table can be quite big if you have many days of data. And for training, all these days, all these bars will be feed into our learning algorithm, which we are typically using random forest. Okay. Now, after the model is trained, it can then predict the return of your strategy, given a specific set of parameters and giving a specific set of market features. So for live optimization, you will still, you know, in traditional machine learning, with a live, with a live prediction, you are only feeding in one feature factor. But because we are actually looking at optimizing the parameters, we are inputting multiple rows to make multiple predictions, even in live. You can imagine we can, let's say, set the look back at the 10 and the entry threshold at 0.5 and the weight as $7 per $1 of GLD, and see what the predicted return is. And then you will change to a different set of parameters and make a prediction again, right? So you are going to make multiple predictions given today's market features and given different combination of your parameters. And then you can simply find out using an exhaustive search what set of parameters give you the best expected return. And of course, the set of parameters that give you the best expected return will be the one that you should set your strategy to for live trading. Okay, so that's that in the gist is the scheme. So, you know, before I go on, let's see if there's any question, because I already explained the gist of it. This is it. The rest of them is to elucidate what put some more concrete meat to the strategy, but it doesn't have anything to do with the general scheme of conditional parameter optimization. So let me actually go back one slide so that this can sink in, because that's it. There's no more to it for the basic algorithm. So apparently it's very clear. So I'm glad. So it's very good. So to apply it to the specific, Bollinger Band strategy on GLD GDX, I'll list the exact trading rule. So the spread is given by GLD minus GDX times their weight. The trading rule is a typical Bollinger Band trading rule. We start trading in the morning and exit at the close. Okay, it's a day trading strategy. And we enter when it exceeds a certain threshold, we exit when the C-score is lower than a certain exit threshold. Very typical. So I don't want to waste your time to go through them. And what we want to optimize are the three parameters where the GDX weight can go from 2 to 4 with 0.5 increment. The entry threshold can go from 0.2 to 5 with different varying increment. And the look back go from 30 days to 720 days. So which parameters should we use for implementing that simple Bollinger Band strategy? Well, machine learning will find out. I can't tell you because every day is different, right? That's the whole point of this conditional parameter optimization, is that it's not a specific number. It's different for every day. So does it actually work? Well, for this toy strategy, apparently it worked in the sense that it improves our return, it improves our Sharpe ratio and karma ratio. Whether it works for your own strategy, of course, you will have to experiment. It's no guarantee that it will work for every strategy, but at least when we try it on a simple strategy, it did improve. The results that are based on unconditional optimization. That means using the traditional method of optimizing it on a fixed training period and backtesting it on a out of sample period. It is that's what we call unconditional optimization. The conditional optimization uses machine learning has of superior performance with all the metrics that we have studied. So let me go back to some questions. Let me see. So Jack asked, if I understand correctly, regimes are modeled as linear, a regression problem. That is not true. A regression problem does not mean it's linear. A regression problem merely means that the target variable has both sign and magnitude. A classification problem means that the labels are discrete classes. But a regression problem can be solved with deep learning network, if you like, right? You can apply deep learning to a regression problem. But the next question is more interesting from Jack, is that how do we see smooth transitions between regime? There is no guarantee that there is supposed to be a smooth transition, right? Because, for example, thinking back to some of the regime that we experienced, let's say the Archegos liquidation in March. Well, it's definitely not smooth. When the prime brokers of the family office suddenly realize that this guy is going to default on the margin loan, everybody started to liquidate. The regime change is sudden on a lot of, and it affects many tech stock, not just a few tech stock, right? So there is no expectation that regime shift is smooth. It is very sudden. And that's exactly what we want to predict, is that are there telltale signs for this kind of sudden transition to a new regime? And again, the last part of the question is, can some sort of unsupervised pre-processing work? No, it cannot work, because we observe already that the unsupervised learning model are too weak to identify regimes that you can actually use for practical purpose. And it's not because I haven't tried. Believe me, I have tried. It doesn't work for me. Maybe it's work for you, but it didn't work for me. Okay, so another question from Akul is, what if we have inherent unknown backtesting bias, market impact? Well, this scheme assumes that your backtest is realistic, right? So if you have a lot of market impact, you have to model that in your backtest. So you definitely, it's not the job of the machine learning software algorithm to discover your bias. They can only learn from what they can see. So you have to make it as realistic as possible. Okay, so the training is in okay, so the question is the training in sample or out of sample. Training is always in sample, testing is out of sample. So all these numbers that you can see in terms of comparison, they are out of sample performance. They are not in sample performance. They are out of sample in the sense that the machine learning model has been built using data that is in the past. We do not adapt the machine learning model to make prediction every day in generating these results. Okay, so Sergio asked if the target variable is to transform the categorical type with several thresholds, can we improve the random forest training and improve interpretability of result? Yes. So the question is, we said we use regression model, but what if we turn it into a classification model with multiple classes? Can it possibly improve the optimization result or the efficiency? And the answer is that's possible. I'm glad that was brought up. So it is possible that with every regression problem, you can convert into a classification problem with multiple bins. So you can always try that. Yeah. For the conditional case, Jigger asked, for the conditional case, like the technique we use, assuming we use random forest, what was used for the conditional base case? As the base exam strategy was described here, right? This is the base strategy. This is the backtest is based on this set of trading rules and this set of multiple potential parameters. So that's the base strategy. So there's a follow-up question from Cameron. So not exactly sure. Let's see. I have to go back to your question to find out which. Yeah. Okay. So Cameron, I think I answered your question already. The fact that this is what I display are all out of samples. Okay, so I see that there's one question left in the chat window, and I encourage you to put it on Q&A instead of chat, so that because otherwise it will always be late in answering your question. Have you tried to synthesize a time series to provide a bit of robustness? So there are multiple ways to improve robustness, and synthesizing time series is one way. However, I would, from my experience, it is not very easy to synthesize a realistic time series. Nature or the market can always give you surprises that no simulation can give you. So the typical way of providing robustness is using cross validation or CPCV, which is again what Lopez de Prado have invented. Is using a technique called combinatorially purged cross validation. Using that technique, you can actually generate multiple different backtests for a same set of parameters. You can still generate multiple backtests. That will, of course, increase the computational cost, another 2 orders of magnitude. But that will allow you to basically form a distribution of Sharpe ratio instead of just a point estimate. Yeah. Okay, so okay, without further question, let me go to the next slide just to conclude. If you have any questions at all about, we have created sample codes for this implementation, so you don't even have to implement any machine learning. The whole point of us building the platform PredictNow is so that you can focus on trading and developing your base strategy and apply machine learning in the most painless way possible. And so if you want our sample code on how to apply CPO to your trading strategy to improve your own trading strategies parameters, please email us. We will provide you with sample codes. The sample codes can be run via our API. So you have to be a subscriber, of course, to use this sample code. But once you're a subscriber, you will be able to implement CPO seamlessly because you don't need to write your own code to do so. We will provide it to you. With that, let me see if there are any further questions. Otherwise, oh, actually, there is Yes, so Carlos did comment that it does not seem that the result from CPO was a lot better than the unconditional parameter optimization, and it is really a matter in the eyes of the beholder, because if you're looking at different metric, it does show improvement, right? Drawdown is reduced compared to the to total return. So as to how much an improvement you desire before you implement the scheme is up to you to decide. And of course, it's strategy dependent, and not only strategy dependent, but it's feature dependent. So this is just the result of a toy strategy. How it works on your particular trading strategy depends on a lot of factors. One is your trading strategy, of course, and secondly, and perhaps more important, is the set of features that you use for this optimization. So it is not possible to make a general statement whether it will improve your strategy specifically. But this is definitely, in my view, a advance over the traditional method of unconditional optimization, because it does adapt to the regime. Okay. So analyze on conditional performing worse. Yes, so I don't know that you can analyze it. You can, for your own strategy, you are in fact encouraged to analyze the period where the conditional optimization underperformed. Definitely, you should. Actually, we analyze it ourselves when we apply to our own strategy. So this is not all theory, right? We actually apply to our own live trading strategy. And indeed, there are periods that the conditional optimization underperform, and we would like to understand why. And oftentimes, the reason why is that it reduced the risk, but it reduced the return more. So, typically it avoided certain risky regime and it reduces drawdown, but unfortunately it also misses a lot of very profitable trade. That was the reason that it affected certain period unfavorably. But the answer could be different for your strategy. So definitely when you apply CPO, you should compare with your unconditional method and see what is the period where it underperformed and why. There are many ways to figure out, why is it that they are picking those parameters, those trading parameters, and why are those parameters being picked and why are they worse? So these are valid questions to answer. Yes, so the backtest for a given set of parameters is based on historical backtest, that's for sure. As to how many bars it is using, that certainly depends on your strategy, right? There's no general answer to that. So the label could be, as I said, 1 day total return, or 1 hour total return, or 1 week total return. It depends on how often you want to adapt your parameters. I believe the in-sample period is about the same. Actually, probably we typically use 2/3 of a total data set for in-sample training and the last 1/3 for out-of-sample testing. And as with everything in machine learning, in-sample, of course, performance is better than out-sample. That's why we don't even bother to show it. Follow-up question, does the CPO technique perform better than running regression, including more recent periods? That is a good question. We have not performed that test of using what is called the walk-forward optimization. We have benchmark it against the what is called the fixed training data. So we have not benchmark it against walk-forward optimization. That's would be an interesting extension for comparison. But again, that would only be relevant to this toy strategy, right? It may or may not be relevant to your own strategy. So it's really up to you to compare this method with the two different benchmarks to see if it adds value to your own strategy, because just because it adds value to our own may not mean anything to you. Yes, so this method is universally applicable. So again, I do not want to give you the impression that this is a method developed specifically for this pair. This pair is purely a toy example. So you should not, in fact, this methodology is applicable to many more problems than finance. I did not mention all the other applications that one can think of in optimizing industrial process, such as hospital emergency room wait time optimization. That's one intriguing idea that we are exploring. And there are many other examples outside of finance that this method can be applicable to. So I do not wish to give the impression that this is developed just to optimize the GLD versus GDX trading strategy. So Jigger talk about feature selection algorithm. So that is the topic of our previous 2 papers and webinars. The recordings are available. If you ask us, if you email us at info@PredictNow.ai, we will send you a link to the webinar as well as the paper for our past webinars. So in those past webinars, we have discussed in great detail the CMDA feature selection algorithm. We find that to be most effective, but the implementation is our own. So CMDA was proposed by Dr. Lopez Prado, but there are a lot of nuances in implementing it, and we discussed those nuances in the papers. Yeah. Yes, so the comment is that it is an interesting problem to solve with sparse data set, such as fixed income or CDS. Not completely sure, what the effect of sparse data set is, because how much data is needed to train a proper model often depends on how strong a signal is and how good the features are. Right? If you have very predictive, very meaningful features, you don't need a lot of data. Sparse data could be just good enough. But if you have very noisy data and very weak features, you need a lot of data to train a proper model. Yeah. Okay, so it seems that there are not further questions, but again, if you have, please feel free to reach out to info. We're happy to answer them and happy to provide you with any source codes if you want to try this out. And thanks for coming.
Yeah, thanks for coming. Just 2 quick notes before we leave. So first of all, as I mentioned before, we did record this, so we will be getting a recording out in case you want to rewatch it or review any of the concepts. Number 2, we're offering a free consultation call to anyone who's attended this webinar of whether they want to have just a discussion, 30-minute discussion online about how to specifically maybe implement this into your processes or trading strategy. And finally, if you found this informative, if you sign up for a free trial on our website, there's additional educational resources in this financial machine learning kind of area. We have about 5 hours of webinars and 3 papers that are informative. But nonetheless, if you have any questions or are interested in booking a consultation call, please email info@PredictNow and we can set something up probably next week. Thank you for joining.